Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So after a clear rejection of the 200-day moving average, the SP 500 has been moving down, and more importantly, we've had the 200-day moving average continue to point down non-stop since April of 2022. Now you can see very quickly on this chart that it's been over half a year where we've seen the 200-day moving average point down. Quickly zooming out on this, even during COVID, we did not see such an extended period of downwards momentum on this moving average. In 2018, we didn't. We have to go all the way back to 2008 to find a period that is comparable in terms of the length of time that the 200-day moving average has been pointing down. Now this is very clear on this chart here. The number of consecutive days with a downward sloping 200-day moving average. We really haven't seen anything like this since 2009, before that 2001. So we are going to be studying that in this video. Does it change the entire structure that we have in the market right now? We really should be asking the question whether we are indeed in a similar setup to the one that we had in 2008, where things started out slow, but the downtrend ended up accelerating as the bearish thesis really took hold of the market back in 2008. So we're going to be diving deep into this topic, trying to figure out everything that we can about it and see what our conclusions should be based on this development. If you enjoyed this video, don't forget to hit the like button and also subscribe to the channel if you haven't already. Now, without further ado, let's get right into it. Now, let's first approach this from a purely quantitative standpoint and understand whether this signal actually gives us any indication regarding future returns. When this happens, when we hit this line, this dotted line where you have lots of consecutive days with a downward sloping 200-day moving average, does that mean that returns are lower than average? Does that mean that the market is going to go down looking forward? And so you can see the results are very clear. There's absolutely no conclusion to make. It's a 50% positive return on pretty much all time frames that are relevant to us, which is really the 6 to 12 month time horizon. That's where we can make the biggest macro bets. But of course, 50% is an underperformance. It is an underperformance when you consider the fact that the market tends to go up over time. Stocks supposedly always go up, right? Well, a signal that gives you 50% odds that you're going to see more downside in the next year is actually a pretty bad sign for the market. And that makes sense, right? We've talked about this extensively. Inflation has broken out. The era of easy money that we've had since 1982 is over. It's behind us. Economic forecasts that say inflation is just going to come back down to 2% and stay there, lay flat, and do this type of development knows absolutely nothing about history, right? So we know that this breakout here is a destabilization of the system. We're not naive to that. But what I found very interesting with this chart, it gives us an incredible insight that while in some cases like 2008, stocks had a lot more downside to go, and 1974, stocks had a lot more downside to go. Even 1969 here, stocks had more downside to go. But in terms of the timing and how long the bear markets lasted, you can see typically, right, the 200-day moving average does not stay downward sloping for much longer than what we've already seen in 2022. So returns in general are bad because in some of these cases, it was before massive drawdowns like 2008, 1974, and of course the Great Depression that helps really push down the performance of the stocks. But what we can also see on this chart is that bear markets typically don't last much longer than the one we've already had. So what this really means is that this is make or break time for the SP 500. This is really make or break for the stock market, the economy in general, because you can see in these three examples, 1974, 2001, and 2008, this signal was actually occurred right before the big capitulation event. Unfortunately, that's how the market typically behaves. Bull runs start out very quick. You get a very powerful move up off the low, and then they start slowing down and normalizing. We had that for example, in 2008. In 2018 here, very powerful move off the low, and then it stabilizes. 2020 again, very powerful move up off the low, then it stabilizes. Bear markets, on the other hand, don't happen like that. You get a slow rollover right here in 2008, slow rollover, 2000, slow rollover, and then it accelerates to the downside. So very different behavior. Now this is really where max pain theory comes in, because investors who want to take advantage of the upside, by the time they realize that the tide has shifted, it's too late. The market has already run up 40-50%. Whereas when the market is topping and making a significant top, well, like in 2008 and 2000, well, that leaves plenty of time for people to accumulate at the very top in 1999 to 2000 and 2006 to 2008. So if we do continue moving down, we are at that phase, right? And I can show you again, 1972 right here, slow rollover right there. And then you get the acceleration to the downside. So if we do continue moving down here, and we're going to discuss whether that's likely in just a second. But before I do that, I really just want to give you the facts, the data, the education, so that you can make your own mind up, and then I'll give you some extra chart, and then we'll take a look at some extra charts to perhaps give you an additional bias. But if we continue moving down here, we are at that phase where things take a turn for the worse very, very quickly. But history shows that that doesn't actually last very long, and I'm going to show you exactly how long that is. But before I do so, don't forget to hit the like button if you're enjoying this episode. I'm really trying to bring about a new method to make them more engaging, to make them more educational, more valuable to you guys. If you're noticing that and you're enjoying it, don't hesitate to let me know, because that really helps out the channel. So as we just mentioned, history suggests that the downtrend that we're seeing right now is unlikely to last much longer. And let me give you a couple of examples right here. Now, you have this reading right here that occurred in May of 1974. Now let's look at where May of 1974 is on this chart. It's around here. And let's see where the market actually bottomed. Well, it was September of 1974. So barely 6 months after that reading, we had the bottom. Now, yes, it was another 35% lower, but it really didn't last very long. Now, fast forward to 2008 right here. Well, you actually had this reading right before the crash. So in September of 2008, right here. And where did the market bottom? In March of 2009. So again, barely 6 months after that reading, you had the low in the markets. So this is why this is really the make or break moment for the stock market right now, and why you can absolutely understand that a lot of people are hedging risk in the market. They're very fearful. Things like the put call ratio have been going absolutely through the roof. We've been talking about that. And the number of bearish investors relative to the number of bullish investors has been pretty much at rock bottom for the last 6 months right here, which I can tell you is incredibly rare. Even during the financial crisis, you didn't have sentiment on this indicator at least stay this low for this long. So we've taken a look at this dot and this dot. So that's already great. But what about all the other dots? What about all the other data points? The only times in history, and this goes back to 1928, so almost 100 years of data on this chart, the only 3 times where we've seen this signal not time the bottom of the market within the next 6 months was 1929, 1940, and 2001. Now, of course, it happened 3 times. It could happen again, but this speaks to the probability that we continue to see a bear market for over 6 months and the market doesn't bottom within the next 6 months. It could happen, but history shows that that's really not what we should be expecting. And now all the other dots, all of them basically coincided or nearly coincided with market bottoms. And that's a much larger number of data points than the ones where returns were low. Briefly looking at this chart, I see more dots at bottoms than dots predicting collapses, but with the big nuance that if the market is set for much larger drawdown, well, it could happen now. And of course, these are all things that we try as much as possible to take into account at gameoftrades.net. It's of course represented in our model portfolio. We're really looking to be aggressive right now, but very much staying aware of the risk and hedging properly against these risks. We do lightning reports to keep you updated multiple times a week on all the key trades that we have, macro notes to keep you updated on the background research that we're doing to find opportunities, and then of course walkthrough videos taking you step by step on the key trade that we have in our model portfolio. So if that's a service that you would be interested in, make sure to click the link in the description down below. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed. Now in the meantime, I wish you good luck on your trading and see you next time.